We've heard your questions and it's time to give you what you want. A Pizza and Property Q&A episode with two of the leading experts in Australian property data. How do you time the market to sell a property?
You want competition from other people that are selling in your suburb to have great campaigns.
Arjun Paliwal, Head of Research and founder of InvestorKit, and Junge Ma, Lead Research Analyst, answer the property investing questions you've sent in.
In those markets, things can all fly off really quickly off the shelves, but this is the part where it gets tough.
I don't think it's a good idea to when it's an early adopter because growth is slow, competition is not really high.
Write that down, write that down!
As well as sharing some of their key personal insights of the property market.
Why should other states copy a policy that is actually hurting people instead of working well?
I think Jung's also too nice to everyone here. Why I say too nice is that
not to mention touching on some of the more sensitive topics of the current housing market.
it'd be lying if we said every time everything was perfect. Something happened in 2022 where all the metrics just suddenly changed.
Even though the housing demand is low, it doesn't make vacancy rate high.
Next question is, how do you feel confident an area will grow? I'd like to feel this one. If you want to understand more about the growth drivers behind how massive equity can be built in the Australian property market, this is an episode you're going to want to listen to closely. My name's Todd Sloan. This is the Pizza and Property Podcast, and you're listening to my chat while I ask your questions to Arjun Paliwal and Junge Ma. Arjun and Jung, how you guys going?
Great, Todd. It's the first time to have us three on together.
Yeah, I don't really do two people on the show at once. So this is a bit of a first time for me. And I know there's going to be a lot of people looking forward to unpacking this episode because got two of the strongest minds in Australian property data sitting in front of me right now. A whole bunch of questions you guys have sent in. And I just wanted to ask before we get into all the questions, is there anything either of you really wanted to set the stage with, or do you just want to jump into the Q&A?
Let's jump into it, but before we do, I'd say one strong mind over here and one person that takes credibility. So I just take all the credibility up front, but I take all the credit, up front.
Okay.
And she's got all the strong minds that helps me with that credibility.
You're always very modest, Arjun. Well, look, I wanted to jump in with a short but sweet one. This is from Lulu. Okay, we've got a few questions in here that really go into some detail.
Yeah.
Lulu's like to the point. How do you time the market to sell a property? Who'd like to fill this one?
Yeah, I'll start off with it. So when I think of timing the market to sell a property, firstly, let me think of it from the aspect that someone's selling and they want to get the best result, right? And so let's just assume they're selling it and they want to get the best result. So how you can know that the chances of you getting the best result are high are around the timing piece. Like you want to time it so that I get the best chances to sell it high. Well, firstly, competition. Right? Now you want competition from other people that are selling in your suburb to have great campaigns. And you don't want that to be like isolated because usually when a market's running hot, sometimes even the worst sales agents, the worst campaigns can look pretty darn good, right? There'll still be differences even in that between a great agent and a great campaign and a less great one. But it's clear that in those markets, things can all fly off really quickly off the shelves.
Yep.
They can have a lot of people attend open homes. They can even make areas change the methodology of sale to things like auctions coming up more often just because they think that that is like a really important way to sell with high competition. And it can make people just even consider stuff that they wouldn't normally sell, like a tenanted property, and they would usually maybe wait. They just let it go because they know how hot the market is and someone's likely to come there. So I think that's a key thing to consider.
Can you just jump into something quickly there? Selling a tenanted property. When I was an agent, I was always advising against it so strongly, but some people are like, no, I don't want to miss out on the rent. Can you open up a little bit from your perspective why that's not a good idea?
Yeah, firstly, it's not a good idea because you don't get to show the property in its best light when you're selling it. Secondly, you also are limiting sometimes the audience of who buy it. And if we think of Australia's generic audience, it's 70% owner-occupier or 65% in some cases, and typically 30 to 35% renters. So if we're looking at the 30 to 35% renters, that's the investment proportion of buyers coming in there, whereas the 65% is the owner-occupier. You're basically saying 2/3 of the market needs to have more challenges to buying this property. They need to look past the visual appeal not being there. They need to look past someone actually staying there for longer than their preferred dates. So there's like things that they need to jump over. Whereas the investors just like, okay, that's it for me. Now, here's another thing. Even if you say attract the investors, you can attract investors with a negotiation mindset that's heavier now because they see that the rent is possibly lower in today's rental markets than what the actual market is needing. or what the market charges. So say if someone's at $500 per week, but then the open market could be at $550, even if the open market could be $550, the investor buying it now just sees 500 and they think that that's on 500 forever, and they want to hustle you down on price to go, no, it's not achieving much rent, I want to push it down.
And you're going to do that.
Absolutely. Yeah. And so you're just talking to an audience that's not emotionally invested, and you lose a lot of buyers. But in that case of seeing a hot market, there are many agents that will basically go, hey, just get rid of it. We'll get you the dollar, get you the contract. And so as a result, you'll see even people selling it with tenants in there because there's such confidence in the market. And that clearly says that could be a time to market position to sell if that's part of your goals. But I think before selling, you should also consider cycle positions. That's something Jung knows really well, so I'll hand it over to her. Yeah, well, but cycle positions are important to know as well.
What should you be considering when it comes to a cycle position?
So from a cycle point of view, I guess you definitely want to sell when the market is growing.
Yeah.
But when it's growing, it can be in different cycle positions. In InvestorKit, we categorize them into 3 types. One is early adopter, one is hotspot, and the other is second wind.
And so when it comes to selling, is there like an ideal one out of those 3 to be selling in?
I don't think it's a good idea to sell when it's an early adopter because growth is slow, competition is not really high at that time. Yeah, a better time would be either when it's hotspot or when it's a second wind. When competition is high, the market is low or even still lowering. And the vendor discount, the discount you will potentially be giving is low or decreasing. Yeah, those are the times that would be better to sell.
My first thought is, what if the market doesn't get a second wind and you're like, oh, I want to time it. I want to do that because I want to milk as much growth as I can out of the hotspot phase. And then I'm going to wait for the second wind phase. Is it like they always go through a bit of a second wind, or is that like a most of the time? How does that work?
Look, it's not always. It's not always. So sometimes if you have a look at, for example, between 2000 to 2004, markets like Brisbane and Adelaide were some of the best performers during that time. Now, when they were the best performers during that time, this cycle kind of calmed down around 2006.
Yep.
Between 2006 and 2012, to even 2006 to actually 2018 or 19, there was only one second wind, which around 2011, where there was a bit of a spike. But then outside of that, there was little to no growth in those markets from 2006 almost till 2018. And so if you're aiming for a second wind, those markets weren't showing it at that period. Just for a brief moment in 11-12, there was a bit of a jump there, but not much. And so what I'd say is that, no, it doesn't always happen. But when it does happen, we can see the data points. For example, in 2017, Melbourne and Sydney's cycle ended. And 18 and 19, they started calming down, and we could see their decline starting to take shape. But around 19 and 20, we saw those declining curve lines start to stabilize. Time to sell found its bottom, vendor discounting found its bottom, and listing levels started to calm down a lot. All of a sudden, 2021, a new growth cycle emerged in Sydney and even in Melbourne before they calmed down in 2022 and didn't do much at all. And so what I'd say is they saw a second wind, especially in Sydney during that time, and that allowed for it. So some markets saw it in 2 or 3 years. Some markets did it for like 10 years and didn't see anything.
What's the minimum amount of data sets that you guys would want to overlay to be able to go, all right, it's not the full picture, but it's probably enough for us to really look at this and go, yeah, like we can see that this is going to start slowing down soon. Or do you know what I mean? Like, because normally you're packing on that many different data sets that you're very confident with the picture. What's the minimum? So someone at home can maybe go, all right, I can grab those 3 or I can grab those 5.
Look, I wouldn't say there's a minimum. So the reason why is like with data, it's all about confidence, and your confidence increases when you can start to see 3 things. One is trending data, generate a picture. So if you can see a trend, that's your first layer of confidence. And so trend just means, is it rising, is it flat, or is it declining across many indicators? And if you can see that, that's your first sign. The second is static, so where it is today. Like if you're trending, but then you're at a very high level of inventory, I'm not going to be happy just yet because high inventory means there's a lot of stock in comparison to what they're selling. I need both the trend to look good and also the actual number itself to look good to get high confidence. And then the third and final part is the depth of metrics. Like if I just look at sales volumes alone that are rising and I go, oh, something good's happening here. But then I see a lot of listings available. I don't see time on market starting to get faster. I'm using my blinkers are on and I'm looking at a metric in isolation. So I wouldn't say that, you have one thing that stands out. You need trending, static, and you need depth of indicators, and you need to see more and more and more to feel good.
So is the depth the amount you are stacking?
Yeah, it's like, okay, if I see a picture where days on market's declining alone, cool. But then if I see days on market, vendor discounting, increasing auction clearance rates, lowering listing levels, increasing sales volumes, lowering vacancy rate, it's just like if you're sitting there and someone goes to you, hey, there's 10 things you should look at and 8 things are looking good, you're going to give it a crack. But if it's like, if there's like, hey, heads or tails, and it's not your 50-50, it's only 2 out of 10 indicators that you get it right, you probably don't want to bet your house on it, do you?
No.
And so that's kind of where I'd say the more confidence you get is the better. But also there's the dangers of the more confidence you get, you're going to either compete a lot or you're going to clearly say it's declining. One of the two, right? In terms of which direction you look at the data. And so I think that can also come up with dangers too.
So is this kind of what Arjun's talking about with like the depth of it between maybe like an early adopter and a hotspot? Because if it's an early adopter, then there's not as much depth to the data. But if it's a hotspot, it's going to be deeper, or are there maybe exceptions to that?
Yes, right. When it is a hotspot, everything would be looking good. Yeah, when it's an early adopter, things are trending towards the better direction, but not deeper enough. For example, inventory level, when it's an early adopter, it could be trending down from 6 or 5 months of stock. It's not as good as what we want as a hotspot yet.
Gotcha.
Days on market, it could be trending down from over 100 days. It's trending down, but it's not low enough. It's not competitive enough yet.
Gotcha. Okay. So essentially, if Lulu's trying to time a sale, she needs to make sure that there's competition in the market. So don't try and wait for the very top of the market, because otherwise you might be too late. If you want the best outcome, you want the second wind. However, there's a big risk that comes with that, because maybe it's not going to come, because then you've kind of milked it for all it's got, if I've understood this right. And you really want to make sure that you've got a nice solid depth of data. I like the depth of data. It makes me think of that big pool in Dubai that you just like swim down like 20 meters or whatever. But anyway, you want to make sure you got the depth of data. So it's not just like a few isolated indicators going, okay, this is all looking good. You want as many on your side as possible to go, yes, now is the time. People are going to pay top dollar. Have I understood you right?
Absolutely.
Yeah. Awesome. Anything else you guys want to add to that before we get to the next question?
All I'd just do is add one point to say property is very illiquid. And so when property is very illiquid and you start seeing trends forming, you get high confidence.
Yep.
Because if trends are forming, it's taken many transactions to get it. And transactions aren't this thing where someone lists and sell overnight. It takes weeks of campaigns and months of days on market reporting, sometimes from settlement or exchange. So the key thing here is that property being illiquid, when trends start forming, they rarely start stacking up on each other. It's very rarely you see a trend where something increases for a few days or a few months, and then you're like, oh, it's been a few months of listing, obviously outside of seasonality times, and it's been like a few quarters of listing periods that are declining, and suddenly it stops declining and it goes back up again. It's not like a Forex trading chart where like you could say, oh, the candle bars are here and I think this is going to absolutely shoot off and rocket up, and then all of a sudden the market's open in the morning and it dips because some news story happened. It doesn't happen like that. Property's very illiquid. So if you see a trend forming, they're usually stacking up on each other. It's not like 10 people decide to list, listings flew up, and then the next month no one decided to list and now listings fell off. It doesn't happen that sporadically.
Just quickly on that, you said something that piqued my interest around seasonality times. I remember I always used to find I would sit down at listing presentations and people would say, oh, we've got a pool. We have to sell in like December or November or whatever. And it's like, actually, no, the opposite we always found were true, because everyone but the pool thought that was the best time to sell. And so now all of a sudden you've got all of this competition when you're the vendor. Whereas if you're selling that around like maybe autumn, springtime, whatever, or even winter, no one else is selling. They'll think it's a dumb idea. But if you want a pool, you want a pool. You Like
Doesn't matter the season.
yeah, is that something that you guys find in the data as well, that whole like, oh, it's got to be spring selling season? Is it a myth, or do you actually have data that backs that up to go, no, it actually is a better time to sell?
We don't look at seasonality as much. And the reason why is that every single month of the year, our clients are expecting that we get them a good result. And so that means that every month of the year, we need to look at the data around the country and go, where is the pressure indicators high? Irrespective of if it's a good season for buying or a good season for selling or whatever it is, we just need to look at that data to go, this city's strength in data is beyond the season. Now, of course, we know in business, season has, times when inquiry in real estate is higher and times in inquiries where real estate is slower. And I'm sure that follows through to the market. But because we're not making like a micro singular selling decision each time, we're making a buying decision, we have the whole country, and the whole country we can look at to make the best data-driven approach.
Lulu, I hope that answers your question. Next, we're on to Akib. I apologize if I haven't pronounced your name right, Akib. Which LGA in Melbourne has the most opportunities from a statistical point of view for a $500,000 to $600,000 range?
Okay, I'll start from data point of view.
Mm-hmm.
So in Melbourne, in general, when we analyze property markets, we use the SA3 level data.
Okay.
And in Melbourne, the greater Melbourne region, there are 40 SA3 regions.
40 of them, okay.
Yep. And the median house prices in these 40 regions or SA3s range from 625,000 to over 2 million.
So it sounds like we're just out of Akib's range there.
Yeah, but we were talking about median price, right? If we look into those regions, there are still areas with nice properties within that 500 to 600K range.
Gotcha. Yep.
But among these 40 regions, we would say only the bottom 5 or 6 SA3s have nice houses in that price range. And I guess all of them are either in the west or in the northwest, where there's a lot of construction happening.
Okay, so how far west are we going? Like Deer Park sort of way, or not quite that deep? Or
in terms of west, we're talking about Melton, Wyndham, that part.
Yep.
And northwest, we're talking about Sunbury.
Yep.
Yeah, that area.
And as far as the most opportunities, it's sounding like it's not so much that these have the most opportunities. It's more so because of the $500 to $600 price range. It's like we've kind of already got such a huge restriction on this. So then picking the areas that maybe do have the most opportunities is a bit of a tricky one to do when you're already dealing with such a low entry point. Have I understood that right?
Absolutely. If you've got 40 SA3s in an area and only 8 of them have a median price that goes up to $715, that means that you're already kind of backs up against the wall for choices of markets.
Yep.
Now, it doesn't mean you can't get anything, because remember that 40 is divided across 5 million plus in population, right? So it's still even that 5 or 6 out of 8 of those affordable SA3s could still be better than your next 3 biggest regional cities, right?
Yeah, okay.
And so the choices are still there, but the key thing is to recognize that if you have an emotion point or a motive point attached to it in terms of I want to be this close to Melbourne, I want to be in these hubs, and you want to get freestanding houses, that's not going to happen. You're going to have that rule cut out and focus on where the affordability sits. Now, if you're looking at affordability and you're down to maybe say 5 out of the 8 SA3s, which have median prices sort of going up to 685, you get left with these 5. Brimbank, Northwest. Sunbury, Northwest. Tullamarine and Broadmeadows, North. Wyndham West. And then you get Melton / Bacchus Marsh, which is the far west. All of these have modern family homes, except for the 2 in the north side being Sunbury and Tullamarine, Broadmeadows, and even Brimbank. So now you go one step further. Am I an investor that's open to all sorts of looks and feels property? I don't mind renovation projects. I don't mind touching up houses and having bigger blocks of land to consider potential. If you want that and you're open to that, now you've got all 5 open to you, but maybe you'll only focus in on Brimbank, Sunbury, and Tullamarine / Broadmeadows.
And why is that?
Because those are just slightly more established than the other 2. So therefore established suburbs have properties that are built in the 60s, 70s and 80s, and therefore bigger land and more potential to renovate or develop. Now, if you're going, I actually want modern family homes. I don't have to think about it. I just want to get my foot into Melbourne.
Set and forget.
Set and forget.
Yep.
I don't mind if the land size is smaller because Australia is trending smaller as a whole anyway. Then you've got Wyndham and Melton Bacchus Marsh as your two focus. And then you've got the Tullamarine Broadmeadows with some assets there. So you can see how you've gone from Melbourne as 40 SA3s down to about 5 that may fit in budget. And then down to either 2 or 3 depending on which one you prefer more from a strategy. And then lastly, now you have no choice but to decide from them. So it's not a full performance outlook because of your budget, but it's just like, these are the options I'm dealt with, and I want to get the most I can from these options.
Now, just in case Akib's thinking, I just want one area.
Okay, let's do it.
Let's say he was open to all of it. And he's like, yeah, I'll reno, I'll do whatever it takes. I'm just keen. I just want the best return. And if he was a client and it was just like, do whatever it takes, is there like a standout out of all of those, or is there still too many variables?
Absolutely. So I'd say this, right? If you're looking at I'm open to renos, I'm open to slightly lower social communities, I'm open to just getting into it and then getting the cheapest I can and the largest parcel of land, I'd go to the SA3 of Brimbank. Right? Suburbs like Deer Park, suburbs like surrounding that and St. Albans, Sunshine, Albion. I mean, some of these are more expensive, some of them more affordable, but these are going to be the areas where you get that price point, the reno potential. You're in that middle west of Melbourne. That's the way I'd go. If you're going to the most affordable, but you need to really get the nicest property and you don't want to touch any of the works, then you're looking at the Melton Bacchus Marsh area, right?
Gotcha.
The downside of that area
You're a lot further away.
A lot further away, but that's not really a downside. The data's still warming up there.
Okay.
I would say just one thing to be aware of the West is we are in this cycle of Melbourne where it's an early adopter. And an early adopter means that the market's not heated up enough to say that you're going to settle and you're going to be in instant competition and capital growth is going to start looking at it. That also usually correlates with rental markets at most cases not being as strong either, right? And you've got some higher proportion of investors in these areas, and therefore you may have vacancy rates a little bit elevated, or you may have a bit of competition. Now, we've noticed that because if we look at the far west, many of the suburbs have vacancy rates between sort of 1.25 up to about 3.5, right? Now, the two markets.
Did you say 3.5?
Yeah, there's some pockets with 3.5 if you look at it.
Jesus.
And so when you look at that, the key is that that's a result of some of the established areas not being out west. That's more of the newer areas. And that's a result of affordable investment properties too that people have been buying that are fairly modern properties and they've been stacking up the investments there. So I think when you're in a cycle position where there's that vacancy rate, you've got to look at it as going this. I'm going to either just target the ones with the tightest vacancy and I might not get all the assets I like, or I might get the assets that make me feel good, sleep well, modern, neat and tidy homes, but I've got to be open with maybe a 3 to 5 week, even 6 week rental campaign. And I got to be open to having 1 or 2 applications at each time, not a lot. And I'm keen to be early in the cycle before everyone comes in here, right?
So basically,
you've got to look into that.
If I'm happy to hold potential of a bit of pain,
Yes.
then there's potentially a higher long-term gain.
Absolutely, because you're buying a market in its period of doldrums, right? Like you're in weakness periods. You're getting a market where people are like, just uncertain, unsure. Investors are getting out, and you're getting properties that probably will cost more to construct than, a lot more to construct than what you've paid for, and they wouldn't have been built that long ago.
It just makes me think of that triplex or fourplex you built in Tassie, or not bought in Tassie. And it was like at the time, I remember you telling me about that, and people were like, "What are you doing that for? Oh, it's dead." And that's been one of your best performing assets, isn't it?
That's right. That's right. So yeah, you're getting in early, right? I got into Tassie in 2017. Obviously, Hobart started in 2016, but regional Tassie had not picked up yet. And then 18, 19, 20, before the COVID boom, was already phenomenal years.
Akib's looking out west, Deer Park. We're talking, or like around that kind of Bacchus Marsh. If we're going kind of more northwest, that's where we're obviously a little bit further out.
Yeah, northwest established, Brimbank SA3 affordable, Tullamarine Broadmeadows affordable, or you're going to Melton and Wyndham SA3s if you need more modern homes and you don't really want to touch the renovations or any subdivisions or potential like that. Look, 500 to 600 will still be tough, but it's a squeeze in if you can find the right one.
All right. Is there anything else that you wanted to chuck into this one before we move on to the next question, Jung?
For this budget of 500K to 600K, it's a bit tricky. I guess you don't have lots of options, but if you really look into those affordable areas, can still find something.
Our next question is from Cam. Cam sent in, how do you feel confident an area will grow? There is so much data out there. How do you sort through this to find confidence in the data? Who'd like to field this one?
I guess confidence here still lies in looking at data points altogether instead of looking at one or two in isolation. I guess I'll give you an example. In an area, vacancy rate is extremely low, like under 0.5%, but the rental prices are not rising fast, or it's not rising at all. If we only look at these two data points, it may seem confusing, contradictory. I guess if you look at other more indicators, more data points, it may make sense. For example, if we look at the last 10-year rental growth, it could be that rents in this region has surged a lot, say 70%, 80% plus, and the affordability has become an issue for the local residents. In that case, affordability could be the limiting factor for rental growth.
Okay.
Doesn't matter how tight the rental market is. Or if we look at the population or demographics of that area, it could be that it doesn't have many houses, or at least many houses for lease, meaning it doesn't have enough supply. Even though the housing demand is actually low, it doesn't make vacancy rates high in that area. So yeah, another thing about population is that if, say, population is not growing, or people are moving out of the city or out of the region, it could also cause a stagnancy in rental growth. So if you look at everything altogether, it's I guess it could make more sense to explain what's really happening in the property market.
What I'm almost hearing there is you keep following the data until it leads to logic, and you go, oh, yeah, that makes sense. Like you said before, like around, it's like there might be a really tight vacancy rate, and let's say the weekly income is like $1,000 a week. You're in an area like that, and you're like, well, the rent should be like $700 a week, and you're like, well, but it can't be because people can't afford that. So it's like you get to a point where you're like, oh yeah, this just makes sense. And is that kind of where the confidence comes from?
Yeah, look, that's one part where it's all kind of talking, like you're getting to a point of conversational logic, right? So it's like, hey, can I turn the data points into a statement? Can I turn into a sentence? Can I chat to someone about it? And they go, oh, makes sense, no brainer, right? But we're coming back to the original part. I think there's a few things where I firstly look at the trend. If I'm confident that something's changing, that's the first part. The second part is the depth of indicators, which we touched on earlier.
Yep.
If I'm seeing many things start to say something is good here, then I start to also see, is it new or has it been happening for a long time, right? If something's new and it's happening, then that's also a new level of confidence starting to change. But if it's something that's been happening a long time, something's been in hotspot for like 6-7 years, then you know it can't keeping on forever. And then the final point I'd also consider is that, there are more certain data points that we have greater weighting on, right? So
when you say weighting, how are you spelling that?
WEIGHTING,
okay, cool.
right?
Yep.
So when we have weighting, we create scores internally.
Yep.
Sometimes it's a 0 to 100 score from an algorithm of predicting locations' future growth. And sometimes we try and keep it simple with other scoring metrics where we do a 0 to 5.
Okay.
Right? And with these scoring, what we're essentially trying to say is some metrics are more important than others. For example, vendor discounting might be important, but inventory is more important, right? Because so many campaigns and so many ways people list in certain areas could be quite different. But inventory, because it's got more transaction data, that to us is more important than, say, vendor discounting is. Or if building approvals is there, building approvals in isolation is less important than inventory in isolation. And so when we've looked at that, we like to score inventory higher in comparison to building approvals. So it's about looking at data in a few different ways like that.
Do you guys also look at it in a way of, okay, when this happens, this should happen. And then you start tracking that and it's like, okay, this did start to happen. It's moving that way versus, oh, wait a second, that didn't happen. Like I guess you're talking about if vacancy rates, or not vacancy rates, like inventory levels start really going down, well then there's, I'm assuming, going to be some knock-on effects to vendor discounting with that, because chances are you don't need to discount as much because there's more pressure in the market. So if they started going down and they kept going down, but vendor discounting went up or didn't move, would you be like, okay, it's time to dig deeper to find the confidence, because this picture I'm looking at doesn't make sense?
We actually monitor all the key data points of all the major cities, including capital cities and regional cities.
Okay.
We put trend charts of all the key data points, including days on markets, vendor discounts, price trends, vacancy rate trends, inventory trends, and so on together. If we do see contradictory trends, we would dig a bit deeper in it and see what's really happening there. But usually, based on my observation, usually the trends are in line with each other. It's very rare to see contradictory trends.
Okay,
it could be because we are just looking at bigger cities, plenty of samples, making data more reliable. And I guess if you look at small towns, remote towns where there are not many transactions happening, contradictory trends could occur.
So really, it sounds like the way that you find the confidence in it is about, it all comes back to me, to this depth, and to really looking at so much of it is all pointing in the same direction. It's like it's going that way. My final question on this is, have you ever felt like everything is pointing towards up or down, and then the complete opposite happened, and you were like, what's going on?
Yeah, look, I mean, it'd be lying if we said every time everything was perfect, right? We have a very positive and a strong track record of like results. We have countless calls we've made correct and they've happened. But then I would say maybe one or two that I'd say, hey, I didn't expect that, would be New South Wales North Coast.
Okay.
So New South Wales North Coast is places like Coffs Harbour, Port Macquarie. I'd say those two, Byron Bay. Going out that whole coastal line beyond Newcastle, right? Around 2020 and 2021, all the metrics were extremely strong for them. And they continue to grow well. So we had the first part of it right. Hey, the growth here is happening. It did happen. We're stoked. But then all of a sudden, 2022 comes along. And I still haven't gotten it perfect to say it was definitely just interest rates or if there was a few other factors. But something happened in 2022 where all the metrics just suddenly changed. Like it wasn't even a slow thing. They suddenly changed.
How sudden? Weeks, months? What are you talking?
I'd say months of data. Remember, property is still quite illiquid.
That's what I was thinking, yeah.
So it was months of data turning into quarters of data. And then all of a sudden, just the pressure came off. Days on market lifted a fair bit. Sales volumes dropped off. Listings started elevating. So that North Coast market softened. Now, when it comes to these markets, they've still been phenomenal long-term operators. So there are people in there that are going to hold for that longer term, and they've still done really well for their rental yields because the rental market's picked up a lot in that 2020-21 period. But then from a cycle perspective, we expected it to extend longer. Like from a 2020 growth, we expected it to go until 23 and 24 potentially. But in 2021, those expectations changed very quickly the next year. And that happened more widespread across New South Wales and even Victoria's coastal locations too. So it's interesting to see that both those states, when I look back at it now, my gut feeling is, hey, could we have seen maybe an affordability shift that happened rapidly as interest rates came along? Could we have seen a preference shift about those areas starting to become pricey for lifestyle now? Could we have seen people maybe questioning their lifestyle moves? Could we have seen compliance changes around, how certain Airbnbs or other factors come into the mix? So there's always a few things going on, not just one thing. But I think that was one example of where all data points were peaking and suddenly a snap happens and then the next year they slow. So that's one that comes to mind. Just to add another point though to this question, I wanted to mention something called rules. So rules are a great way to help you just block the noise out. So an example of a rule could be, I want to target areas with greater than 50% owner-occupier ratio. Okay. Right? An example of a rule could be, I want to get rid of areas with a vacancy rate of higher than 2%. Another example of a rule could be, I want to get rid of areas with inventory levels above 5 months. So you see, these aren't like trending data points. These aren't depth of all these indicators scoring highly. These are just you getting rid of areas that you might think I don't want to touch because of. And the because of might be heightened supply. It could be heightened vacancy for rental supply. Just anything that makes you feel like I want to target these areas and I want to be locked in. That can help you on your data journey of timing markets, getting the right data right, avoiding the confusion if you set rules. And then you go through what Jung said about trending, having the depth of indicators, having things that don't have opposite correlations of things showing. That's all the thoughts that I want to make sure I add to it.
And I'd imagine you want to be careful with those rules as well, not to get too tight with them, because then are you going to just like exclude markets you shouldn't be excluding?
Totally. It's like, there's always, pick your poison, right? Like one thing's going to kill you in one way, one thing's going to kill you another way. You have no rules and you're going to be, sifting through lots of information and data, and then you're going to double question whether you made the right call or not because that area looks good and this area looks good, but those data rules are not showing here. And then you put too many rules, you're going to miss out on multiple locations. I think the too many rules part can be dangerous because if you look at it, it's like if you had too many rules on a property selection, I want it to be 700 square meters or more land. I want it to have, more than 4 beds, and I want it to have 2 bathrooms. I want it to be north facing.
Don't forget it's got to be brick as well.
Yeah, I want it to be double brick. I want it to be built in the 2000s. And then you go, hold on a minute. So developers are out there building all these properties in the 2000s and 700 square meter blocks, and and then you end up going, oh my God, it's been 6 months. I haven't found something. And then you blame the market, you blame everyone else, and you don't blame yourself.
It makes me think of that song that I'm looking for a man in finance, 6'5", blue eyes. It's just like everything has to be so perfect or I'm not going to buy it. And it's like, well, get used to not buying then. Like, I don't know if that's a good analogy.
You nailed it, mate. It's perfect.
All right, Jung, is there anything else you wanted to add on to that one before we move on, or time for the next question?
Yeah, let's do the next.
Next question. All right. Next question is from Matt. So we're back in Melbourne now. What will a 10-year investment strategy look like when you compare Melbourne versus Perth? Who will outperform if we were to buy today in 2024 and why? Who wants to jump in with this one?
Purely from a data perspective,
Yeah.
I would say Perth looks better than Melbourne because in the long term, Perth still has a lot to catch up in terms of capital growth. Last time, Melbourne and Perth's long-term growth crossed over was, I guess, around 10 years ago, 2014, 15. And since then, Melbourne has grown much more than Perth. So just purely from this perspective, I would say Perth has a fair bit more to catch up in the coming 5-6 years. I'd say. And then cash flow wise, rental yields in Perth is
way better.
Better than Melbourne. So your cash flow would look better in Perth than in Melbourne as well.
Yeah, it's a good point. So I think I would agree and disagree here, right? There's a few parts to it. I would agree with Jung's point based on today's data. Perth looks stronger. And that therefore means the growth in the first few years, Perth will outpace Melbourne. That's the part I agree with. But this is the part where it gets tough. And Jung mentioned it too. Jung mentioned for the first 3, 4, 5, 6 years. She didn't mention the whole 10. And the reason why she didn't mention the whole 10 is like, I think of this like the data gives us the foresight for the next 1 or 2 years. Like that's the thing to remember. Data is not a good foresight from a perspective of what the next 5 or 6 years will do. That's a gut feel. Even the next 10 years, it's a gut feel. And the only typical gut feel people realize is this. Because it hasn't done well the last 10, it should do better this next 10. Outside of that, no one in any sort of data scientist position, research position, property analyst position, including us two, and we are here as forecasters and researchers, we cannot tell you that the whole 10 years looks good. We can tell you next 1 or 2 years at a time. And every year we can tell you the next 1 or 2 years at a time because that data metric and the back testing that we've seen and the outcomes it produces is fairly accurate.
Is it kind of like looking at the weather on your phone? Like you look at the next day or two, you're usually good. You try and get like a 2-week forecast. It's like, it's never right in 2 weeks' time. It's too far out.
That's a good point, right? So it's like I can tell you with high accuracy certain days, or in this case, years. But then once we get past a couple of years, it's relying on our experience and gut feel and comforts based on what we've seen in the past. And so I always think of it as this. If you've seen the Olympics recently,
I watched a bit of the skating, yeah.
Yeah. No Bradburys this year, is it?
No. And I couldn't avoid the breakdancing.
And so with regards to this one, I think of it as the 100-meter sprints.
Mm-hmm.
Noah Lyles comes in to win the 100-meter sprints at the end, and he came near last at the start.
I saw that one.
Right?
Yes,
and
yes.
so he's never won that gold medal in 100-meter sprints. He's known as a 200-meter runner.
Yep.
And so when I think of that example, Perth is the rest of the pack. It's Team Jamaica when it comes to the 100-meter sprints. It is winning the start of the race. If in the event Perth continues its market heat, it will be Usain Bolt all the way through.
Did you say Usain?
Yeah.
Have I been saying his name wrong this whole time?
How did you say it?
I thought it was Usain Bolt.
I could be wrong.
Oh.
You know, hey, I said it with confidence. It's what matters, right? I didn't need to say it correctly. I just said it with confidence, right? It's like when I was in primary school and people used to go Arjun, and I'm like, it's Arjun. But it's like Arjun.
Now you're telling me I've been saying your name wrong this whole time as well.
Yeah, but every non-Indian says it wrong. Like, so it's all good. Like, right? But here's the thing. That could be Usain Bolt or Usain Bolt ready to finish the race.
Right.
But if Melbourne really starts picking up from the early adopter position we've got it at, and the next 10 years are the opposite to the last 7 to 10 years, then Melbourne will come out like Noah Lyles in the end of the 10 years and win the race. So if we're talking that last 10-year basis, Jung's spot on. I agree with her that the data suggests Perth's growth rate's better now, which is why it's a hotspot. It could be Team Jamaica, Usain Bolt days and win the start and the end of the race and finish strong. Or it could be like Jamaica was in this Olympics where they came out firing and then USA, Noah Lyles comes back and wins the race at the end over that whole, what we call 10-year market period with Melbourne winning.
If there's some strong changes in the Melbourne market, it's kind of like it doesn't matter if it's in the back of the pack for 5-7 years. It's like it could absolutely shoot to the front in 10 years. And realistically, there's no way we can look that far into the future.
No way realistically can look that far in the future. You're just relying on past history now to say, hey, I've never seen one capital city absolutely flop for two plus decades in a row. I've never seen one capital city remain that underpriced in comparison to the others for that long. So you're relying on like those history, gut, eventually someone's got to look at it and go do something. Someone's got to look at it and go, why aren't you? Or someone's got to look at it and go, I'm moving there. One or the other, right? Or I'm investing there because it's that cheap. So the same thing that people have been putting onto Perth over the last few years, kind of had the same things that Melbourne's seeing, today, or maybe if not today, in a few years from now. We're just saying that today's data Perth's stronger. Over the 10 years, though, that sprint could happen for Melbourne and shift over.
Question, and this is kind of building on what Matt's asked here, but a little bit off topic, but still on it. Political changes that have happened around the Melbourne property market and like the land tax side of things, the minimum dwelling standard, like all of these things that are happening that are making it more difficult as a property investor. Like, do you see those as being something that has a higher likelihood of Victoria reversing and making it more investor friendly? Or do you think the higher likelihood is the rest of every other state and territory going, geez, Victoria's been getting away with that for a while. Let's chuck it on our states as well. And it just becomes a bit more of a norm that maybe it's not as investor friendly overall. What do you think the odds are kind of more in the favor of happening?
That to me is a bit tricky. But personally, I would think the first scenario would be more likely to happen, where all these restrictions, high taxes on investors, squeeze investors out of Victoria, making the rental markets more competitive, rents surge, and tenants would be having a hard time. And that is that would be a rental crisis. In Australia, we are already having a rental crisis. And in Victoria, I guess that crisis would be even more serious because of all these restrictions. So in the end, we may find that all these policies, they are not working, at least from a, I guess, people's welfare perspective, it's not working well.
So you're looking at this from a lens of like, if it was working well, it'd be working well. And if it's not working well, who would copy something that's not working well?
Why should other states copy a policy that is actually hurting people instead of working well, right? What do you think, Arjun?
Yeah, it's a good point. So Todd, I think there is some merit to what Jung said. I agree, because what she said is that if the policy is causing the rental crisis to worsen, which it clearly is with Melbourne's rental markets surging, right? Then you shouldn't keep that going and you shouldn't have other states copy. But I think Jung's also too nice to everyone here. And why I say too nice is that she's treating governments as if they think like us people about the welfare of everyone.
Okay.
Governments don't do that, right? So Jung's thinking nicely here about like, hey, they should do the right thing. It's not good for the welfare. Rents are rising rapidly. Cities are being impacted and people are leaving their investment properties and the government's not adding in the right public housing to match the rental that should be there.
Whereas are you looking at this through the lens of what's going to get me votes if I'm a politician?
I'm looking at it as, hey, I'm the stern politician that took a stance against property investors. I'm all for housing affordability, even though the opposite's happening in terms of like rents are rising faster. The people sitting on that side don't think like that. They just think, yay, less investors, must be better, but they don't have the economic background to understand what actually flows on. And then secondly, you've got other governments who'll go, hey, you're making more money. You're paying off your COVID debts faster. You're getting more juice in the tank. We want that too. And no one can complain about what's happening in Australia if all of Australia does it. It becomes a rule, right? No one can complain about stamp duty if all of Australia charges stamp duty. You can complain about expensive stamp duty in one state and choose another location, but if 600,000 transactions happen a year in property, and you just have to transact for whatever reason, downsize, upsize, relocate, family, investment, whatever, and everyone's doing it, well, those 600,000 transactions will probably still be there, right? And so from that perspective, I think governments may look at it and go, we'll all start adding compliance. So Jung's right in theory by doing the right thing by people. If you want to do the right thing by people, don't come in with all this compliance. Don't add all this stuff in. But I think she's being too nice to say that the governments will follow everyone and just be like, no, sorry guys, we hurt you with this one. We didn't mean it. Oopsie, my bad. Let me remove this policy. And guys, all the other states, please don't copy us. We're horrible at setting policies. We don't like to be copied. No, stop that. Everyone's going to go crazy and going to go, I want to copy what they did.
Okay, so there's a split between you guys. It sounds like Jung wants to believe in the best of people and politicians, whereas you're maybe looking at this as like unfortunately, that's probably not how it works. Pollies are going to do what is best for them and best for getting votes, getting back in, all that kind of jazz. And if it works and it gets more money, well, then other states probably have a higher likelihood of following suit.
Yeah, the world's ruthless, man. The world's a dark place. And so don't, we can be nice people sitting here. We can be nice people to people. But sadly, the world doesn't work like that.
All right. Is there anything else you guys wanted to add on to this question for Matt for Perth and Melbourne over a 10-year time horizon?
No, nothing from us.
Yeah, cool. All right. Next one is from Kate. Now, Kate's got a little bit of a curly one here. Why would I use data to predict market growth when I could just buy instant equity from buying under market value? Who wants to jump in on this?
Ooh, this is juicy. I have a very strong opinion here. So firstly, the industry of real estate investing has created buzzwords that don't actually exist in reality.
Okay.
Right? So I've had 2 property valuers join podcasts and webinars that I've been on, and I've asked them this question. Hey, and this was an interview. If anyone wants to check it out, it's the Property Talk Australia Facebook group. Property Talk Australia. Me and Eric Wu, a finance broker, we jumped into there and spoke to a valuer, and she was lovely. And she said, no, when we value property, we either value it at the contract of sale price or we value it under the contract of sale price because of comparable sales. Under meaning it's overpaid. We do not value houses and go up to them and value them for more than what you've paid if you're buying an established property in Australia. And so that clearly tells you straight away that they are not valuing things more than what you think it is. What you're referring to is something called in comparison to comparable sales in the area, I feel I have purchased well. Example, my visual eye led me to see sales across the area and I saw 500K times 3 properties and I bought something similar for 480. Firstly, big bias. You are making your own assessment of how you purchased and you are making your own assessment of what you think value was. Therefore, you're going to make your own assessment that your decision is better and superior than what others do. And so you may think it's 480 and it's better, but what happens? Maybe you don't have the perfectly shaped block as the others do. Maybe your house is built 2000s, theirs built 2004.
Okay, so you reckon it's a bias that we bring onto ourselves to make us think we've made the right decision?
Absolutely. And it's a bias by property professionals too, because they're in your corner buying for you. And therefore they will say to you, we bought this under market value, to recognize their skill set and what they did. At the end of the day, that value on that podcast said the value of that property will be defined as 3 and 6 months later, sales would have occurred. We will then measure the sales that occur in the area. And if the sales are higher than that property for a similar property, we will value it more. You know what that's called? Market growth. Sales in the area, selling for more than what your one sold, is called market growth. It's not called instant equity. It's not called under market value. The only area where instant equity sits, in my opinion, is one of two areas. Number one, if you've bought a deal in bulk, for example, a unit block where you've bought a unit block of 4 individually titled properties and you've bought it in bulk. And the bulk price you pay is actually cheaper than if you were to look at singular sales of 2-bedroom units in the area.
Yep, okay.
And then as a result, when you buy in bulk and then you then look to do individual valuations, the valuer will not look at your sale 2 months ago, 3 months ago as the actual bulk sale. They will go and out there, because they're asked to just value a singular unit. You've submitted 4 different valuation requests.
Because they're on different titles.
They're on different titles. They will
Gotcha.
singularly look at one actual unit and then go, that's 220, but then maybe you bought 4 of them at 200 each. The second scenario is when you buy a new build. If you're buying a new build and you buy a block of land and you build on it, sometimes what happens is that you've paid a land price in an earlier stage. Now, I'm not an advocate for new builds because I can't say that this will happen all the time, and there's ambiguity to whether you'll get this. But for those who are in that space and have gotten this many times, you buy land at stage A. Now, stage B, C, or 2, 3, 4 is occurring, and your house is now starting to get built. And when your house is getting built, they do what's called an as-if complete valuation.
Yep.
And when they're doing that as-if complete valuation, they reckon that your land value and your house value would be more. Now, in those scenarios, you could argue whether that's land value increasing because that's market growth happening with stage 1, 2, 3 selling, or whether that's your build is slightly cheaper and you got a cheaper price because you wholesale the build, or you got a better tradespeople to do something similar to next door's build but at a cheaper price. These things are TBC, so there's still ambiguity there. But those are the only 2 ways you can get under market value. My last and final point to share is that something Jung and I both agree on is the best deals happen in the weakest pressure markets. So if we look at our cycle and we go early adopter, hotspot, and second wind, there are certain points where deals are easier to make. Therefore, if deals are easier to make and you're getting better negotiations and better deals, and let's just say that person thinks they're under market value, you're going to actually just have lower growth to begin with because you bought in a softer market. So it's better for you to buy, but it doesn't mean that you'll achieve the result better. So that's something to really consider. And I guess my final point on all of this is that when you're looking at buying property and you're looking at, doing all these purchases and you're thinking it's under market, the way people are measuring it is incorrect.
How so?
When people measure it, they're using online estimators. They're using evaluation systems. And they're using software that the banks display as auto vals or system vals. And they're doing them just after. Like, I can tell you right now, CBA is notorious. NAB at times even notorious for their systems. Their systems could come in for a property where I've seen came in at 550K, but I know that property's only worth 500. If someone tried to sell that today, they would be over leveraged to their eyeballs.
I've personally seen that as well. So yeah, I know exactly what you're talking about.
So I think we got to have more transparency and truthfulness to the industry. And I also think that we've got to stop having people even ask these questions because they've been misinformed. And so that's my thoughts.
My only problem with that is if we take it to an extreme, like an unlikely extreme, or not even an unlikely, not going to happen extreme. Let's say there's try a street of houses and they all sell for 700,000. Okay. And then one person is just like, I need to sell in 10 minutes, 500,000. And they're all identical houses, identical blocks, identical everything. That would be under market value, like clearly. Or if it was like 400,000, it's like clearly that's under market value. Where's the line between if they were to sell it for 670, is it under market value or is maybe the market dropping a little bit? versus such an extreme example, like where does that start to go, yeah, no, that is under market value, and the valuer would be forced to go, yes, you got that at an incredible deal?
So firstly, let's talk about the technical aspect. The technical aspect, the valuer still doesn't care. They're going to either agree with that price or going to say it's worse. They're not going to say it's more. Like their risk management, their licenses, their whole sign-off procedures, they're not going to go and say you bought something for $650 and here's $700, right? So they're going to say it's $650. They now will let you go and say, hey, maybe internally he's walking around going, great deal, okay? But the report will say $650.
Yep.
It won't say $700 if you bought it for $650. Right, so now you let go. The value has gone away.
Yep.
It's now the could be, not the. It's clearly under market value. Yes, if you say you bought it for 600 and 700, the whole street, everything's the same. You're right in saying that's clearly under market. But how do you know that the next house is not going to be
selling for 600?
600. How do you know the next house after that's not 620, 630, and just those last streets in the sale were 700? And also, yes, there are estates out there with pretty similar homes.
Yep.
But I can give you an example. My home in Glenwood, which was when I first purchased that in 2015, it was a 2008 build home. So it wasn't packaged. But it wasn't like super old either.
Yeah, it's still pretty new.
Every house in the street was still different, right? You could have a 4-and-2 on 500 square meters of land, and someone could have a better kitchen. Someone could have, double garage versus your single. Let's just say even the double garage is the same. Someone could have different flooring, different blinds, different lighting. Like it's not that simple that every house is truly exactly the same. Things shift, things change in the minors, and they're equal price variances. But if that whole 100K example was that extreme and everything was that similar, I'm still telling you, I don't know. I can say it could be under market, but I don't know. I need to wait for the next 3 months of sales to happen.
Yeah, because then what if the next door then sold for 600 in a month's time?
That's right, because that's why valuers don't say that it's under market. They say you bought it for 600. We're going to assume that that's a fair price.
So the only way that you'd know is in a few months' time if all the rest of them kept selling for 700 in that example.
That's it, right? And so I think that's the problem, because now the problem is that you don't know if that's going to happen. And let's just say if it does happen, did you use an online evaluation tool and made it say 730 now and you think you got it for 100K less? Or did a valuer physically go out there and go, I agree that it's 700. Now we go the method of truth.
Gotcha.
And if the method of truth is fine and you got it at 600 and everything's 700 and everything retains 700, hats off. But now, you're targeting the 0.0001 percenters.
Jung, what do you reckon?
I totally agree with Arjun. You have much more practical experience than I do. But when Katie? Kate.
Maybe you go by Katie, but yeah, Kate. Yeah.
When Kate mentioned instant equity, one thing I was thinking of is discount on apartment when
like an off the plan kind of thing?
Buy from the developer in bulk. I was contacted by a apartment sales agent lady some time ago. She said they could get 15% to 20% discount on apartments directly from the developer.
I can imagine what you said.
Yeah, that could be the instant equity she was talking about.
Maybe. There's nothing more to the question whether she's talking about buying it herself at an apartment through a BA. It's just more of the instant equity versus the data side.
And that also comes to that example I raised, right, which was the new build side. Like that could be under that scenario, which is, hey, that could be a new build where margins are coming off or staged pricing is occurring or certain units are being sold. Like, again, that could happen. I'll always say could, because we still don't know until after that sale takes place, is every builder going to fire sell for 15% lower or are they going to sell and that's going to be isolated at 15% lower? So now I'd say to you is this, when you know there's a lot of coulds in there, and you know the method of measure isn't correct, why not just target markets that are seeing competition and likely to grow?
Well, and that's really the crux of her question is certainty versus uncertainty. But what you've brought to this is the certainty that she feels she has, maybe it's not as certain as she thinks it is.
Absolutely. You don't know if it's going to decline. You don't know if that's a soft market and that's why it's easy to buy. And yes, you got your 50K under, but I just made 50K sitting doing nothing with capital growth as an example.
Yep.
And it kept doing 50K the next year. You only buy once. Whereas the 50K could compound 1 year, another 50K growth could happen next year, another 50K growth could happen in the year. That means I just bought 3 under market values, whereas you stuck on the 1. And I didn't even have to buy 3 properties. I just bought the one that grew each year for 3 years.
It's a very good way of looking at it.
Right. So I think there's more certainty in saying 10 indicators are looking at you in the face and they're just extremely tight. There's more certainty in saying I went into a market and it was jam-packed with people at the open homes. There's more certainty in saying I had rental applications going crazy and like every single property is getting tenanted super fast, sold super fast. There are 50 people in that open home of 50 people and 49 missed out. That's more certainty to me. And that's why when we got it right in Adelaide, when we got it right in Brisbane, when we got it right in regional Queensland and Townsville, all these areas that we talk about that we got it right in from a growth perspective, buying, yes, I'm not going to overpay, but the market doesn't lie. If it's doing its thing, it's doing its thing. 49 people missed out. They're going to lift the price up for the next one.
I like that. So you're basically pulling this apart and saying that the certainty isn't as certain as you think. And the fact that the data, when done correctly, won't just give you a one-off kind of, hey, this is good. It's going to compound on itself year after year after year when it's done right.
Yeah.
Gotcha. Okay. All right, Katie, I hope that answers your question. And a lucky last, we've got Jaden. Jaden has asked, where's the best place to find yield data? I'm trying to find a deal with lower holding costs and have no idea where to start. Now, you and I were chatting about this a little bit off air, Jung, because I think what Jaden is really looking for is more like a data set of yields.
Instead of
Like isolated, just going onto realestate.com, that kind of thing. Whereabouts can you find that?
the most efficient way is always paying for data sets.
Yeah.
But I think if we want to get free yield data,
So
there's
even if he wasn't going to
yeah.
pay for it, where's he paying for it?
for
call up.
example, where we get our yield data, it's APM,
APM.
Domains Data Company,
Yep.
or Ecologic. They also have LGA level and suburb level yield data.
Okay. And if he's like, no, I don't want to pay for it.
There. I don't think there's ready to use data sets with all suburbs or all LGAs yields there. But I guess what we can do is to start from a macro level and narrow your options down. For example, now North Queensland, Central and North Queensland, or WA, they have the highest yields among all states.
Yep.
And from there, we narrow down a bit. I guess you can get the information from articles, blogs, reports, free reports online, getting a rough idea which regions or which cities in those states are having the highest or the healthiest yields. And once you have a city in your mind, it's okay to check single suburbs in it. It's still time consuming, but it saves a lot of time than checking everything.
And I guess that's what you're paying for. If you're buying it, you're buying it to have instantly, boom, here it is, versus you can get this for free, but you're probably going to be in front of the computer for a little while, like putting spreadsheets together one by one.
Yeah, and there's a few other platforms you could chuck in there on top of like Suburb Data, HTag. You could go to Real Estate Investor. These are a few that you could try and find some rental yield
DSR data. I don't know if they've got much.
They could possibly have that too. I think the main thing though is if you want the freest source, you just go to realestate.com.au sold properties.
Yep.
And you see what recent sales there are. And then you go to realestate.com.au's actual properties for rent and you see them when they've actually like favorite them and then they've been taken off. So you know that, okay, that must have achieved what it got before it taken off, $600 a week. And it's a 4-bed, 2-bath. Here's the address. It looks like that. And then if you're going into the area and you see sold properties that are looking like that, 4-bed, 2-bath, similar land, same suburb within the last 3 months, you can go, okay, that's sold for 700. That's rented for 700. I reckon I'll get about 5% to 5.2 yields. And that's just an example of you when you're looking at not data at a suburb level, but you're down to the property decision making, and you can just see that, right? And so I think that's the most real, efficient way if you're locked in on your suburbs and you now want to choose the properties that maybe do some pretty good yields.
You know what I like about that as well is that then there's no lag with that. That is as fresh as it gets. It's like this property was leased and you're like, oh, well, this happened a day ago, 2 days ago, whatever it is.
Yeah, and there's no median data with that. Like sometimes I'll give you an example. People look at medians and there's some affordable suburbs where the rental yield say, I think it's like Berserker in Rockhampton. Berserker in Rockhampton has like 7% yields on the data or 6.5%. And then you actually look at proper 350, 400, 450K properties and it's like not really 7%. They're more like 5.5 to 6%.
Right.
And that's because some suburbs there will have like a 250K sale and then the rent might be for the 3-bedroom at 400. And then you're like, that's crazy. But that 250K sale was in a flooded pocket with mass amounts of housing commission around it. And it was a unrenovated, like lots of works to do, 3-bed, 1-bath on stilts. Right. So like that's where median data can be dangerous for you. And this way I've just shared now is a real way to look at what actually is for rent for the property that you want to buy.
I like that. That's nice and simple. And that's actually a really good point as well, even on the renovation side of things. If you're buying in an area where there's lots of properties that might be selling for 300,000, but they need like 150,000 chucked into them. So really it's a 450 sale, just to pull out random numbers. And if that's renting for $500 a week, where it's really, that's more like whatever that is, a 5.5% yield.
Not the 7% on the
Correct.
actual. Yeah. That's where median sucks for rental data. Have a look at it to guide you. And then just have a look at it from a perspective of individual houses to know what they actually fetch.
I actually wanted to ask both of you guys, what is the most common question you get on a weekly or even daily basis that hasn't been maybe sent in, but that you're like, I'm answering this constantly?
I don't get many questions because I don't deal with clients directly.
I was going to say, you're in the office. You'd be getting questions directly from Arj.
Or the strategists. But the strategists' questions are mostly, I have this property. Yeah, that can be one. I have this property. My client has this property or these properties. They're considering selling. Can you give us some suburb insights?
And how do you normally give the insight to go, yeah, you should versus you shouldn't? Because that kind of brings us back to our very first question from Lulu.
Usually what we do is just to give them the demand and supply or the current trends, pressure trends in that region and in that suburb, along with how much that property has grown since the purchase, if we had that information from IP data. And then, we just list demand. Here is the demand and supply. The market pressure now is high or low, and we have to give the decision back to them because it's big decision.
Absolutely,
to make.
Yeah. And how about yourself, Arj? Do you get that one all the time as well, or is yours a bit of a different one?
I get a different one. So the question I get most commonly is, how long has this market got left?
Yeah,
right?
okay.
And so it's a particular market. So how long has it got left?
Yep.
And this is pretty funny because there are some people out there who think a market's just had its growth, right? It had its time. And I think there's a Facebook group, I can't remember which one it is out there, but pretty large Facebook group, like 60, 70,000 plus, I think it is on there. And questions will be like, I'm thinking of investing here. And then the most common comments will be like, oh, it's done its thing for a few years. And I saw back those comments and they were like going from 2018 for some markets. And they were like someone saying, in 2021, oh, it's done its thing for a few years and it did it for like 3 more. And so I think that's probably the most common one where people don't know how to read if that's going to do its thing for longer or shorter.
All right. So people picking the end of a cycle.
Yeah, that's probably the most common one I get.
I feel like opening up the answer to that isn't a quick end of the episode kind of question.
No, not at all.
No. All right, what's an action step that you guys have got, whether it's one each or a joint one? For anyone that's listening right now, they've enjoyed the episode. They can pull out the headphones and put straight into practice.
My one would be that yield one, going to a sold property, going for rent property and finding the most similar ones within the last 3 months of sale. And then if you can start to see that, you'll see real yield of properties that you're targeting in that suburb.
Awesome. Love it. Jung, agree or you got a different one?
I have to agree with Arjun.
Okay. So getting the yield data together, and I guess it's going to get you to know the market better as well. You're not just gathering yield data, you're gathering a whole lot of sub info that you're going to get from that as well while you're looking into every single rental as you go along. I think, I like it. All right, guys, we've arguably arrived at the most important question of the entire show. I know I've asked you both this question before, but I'm going to ask it again. Arjun and Jung, if you both had to decide on a pizza to share, what is your favorite pizza?
Oh, I don't know if we're going to share the same thing. What do you reckon? What's yours?
You going half-half?
We're going half-half.
Half-half?
Unless I agree.
Okay.
Yeah, I would like a pizza with prosciutto and rocket on it.
Prosciutto and rocket.
Yeah.
Okay. Sounds kind of fancy.
Um,
It's very Italian. There's few ingredients. Like you're going like
Yeah.
traditional pizza
Yeah,
there.
simple.
She's been to Italy many times. That's like hacking. So she knows pizza. And her partner's Italian too. So
Oh, well, of course. I forgot that. Yeah.
look, I'm going to disagree. I'm going to go right half and half.
Yep.
My one's going to be, and I'm going to explain it a bit because I don't know the name of it, right?
Okay.
So it's going to be the thin and crispy like breads,
Yep.
wood-fired pizza.
Of course.
It's going to have a tomato base,
Mm-hmm.
and it's going to have like that sausage, the Italian sausage on there,
Yep.
like chili oil and pretty cheesy. So I don't know what it's called. Maybe it's just called an Italian sausage, but it's like
It depends how thin. Like, are you
the
thinly
ones where you
sliced, like-
lift it out of the wood fire and it's just like flopping over already.
No, I mean the sausage. Is this like pepperoni style thin, or are you going like chunks of this stuff?
It's going random places right now. No, how thin's the sausage? Sorry for anyone listening to Todd's description of sausages, but look, I would say
I'm just building on what you're saying.
I would say, well, maybe it's not even a sausage. I think it's like a chunk of meat.
Okay.
Like it's a chunk of pork. Like, I don't know. If that's maybe what they... do you know what I'm talking about? The pizza I'm talking about? Maybe you don't? We had it together.
I don't know. I can't get out of the gutter, Arj.
Okay, sorry, man. Stay in the gutter. Me and Jung will leave this gutter quite easily.
So I guess what you mean is any meat with chili oil.
Yeah, so Italian sausage, right? The pork sausage,
Yep.
It's good.
Okay. All right. Guys, thank you so much for jumping on this show. I know that this probably isn't going to be the last Q&A episode that we did, and it's been in demand for a little while. I really appreciate both of you making the time for this, and I'm sure we'll see you again soon.
Thank you so much.
Thank you.